Russia's OPEC Plus allies in the Middle East are benefiting from a recent shift in the oil trade market. Since Russia's oil and products are no longer available on Western markets, Saudi Arabia and the United Arab Emirates are benefiting from lower petroleum prices. New trade lines have emerged as a result, and these nations, which have some of the greatest oil reserves, are now buying fuel and diesel from Russia. Additionally, this change in the trading market has been validated by tanker tracking and data commodity services. The US's close partners in the Middle East, Saudi Arabia and the United Arab Emirates, continue to purchase, hold, export, and repurchase Russian fuels. This is taking place despite the US's request for their assistance in preventing Russia from evading the oil-related sanctions imposed by the West. Western countries imposed price caps and embargoes on Russian oil and oil products. The Middle East is now a significant trading hub, and as a result, the oil trade has shifted away from Russia. Russia's oil exports to the United Arab Emirates hit a record high of 60 million barrels in 2023, treble the amount of the year before, according to P.R.O statistics that was quoted by the Wall Street Journal. Russia is currently supplying a lot of oil products to Fujairah, the main trading hub in the United Arab Emirates. Furthermore, Argus Media predicts that in terms of volume, Saudi Arabian gas oil now ranks second only to Russian oil products. Furthermore, the UAE is developing to become a hub for the transportation, covering, and exchange of Russian oil. Saudi Arabia, the top crude oil exporter in the world and OPEC leader, is now receiving fuels from Russia. Within the OPEC Plus partnership, they lead both OPEC and non-OPEC producers. For more than 6 years, this coalition has been managing the supply of crude oil. According to P.R.O, Russia is currently supplying Saudi Arabia with over 100,000 barrels of fuel per day, a considerable increase over what it was doing prior to the Russian invasion of Ukraine. Furthermore, it appears that Russia is exporting fuel to Saudi Arabia at a faster rate. They can either send it straight to the destination or move it from one ship to another to do this. Since the EU ceased importing Russian oil products by sea on February 5, Russia started selling diesel to Saudi Arabia in February. Since the EU forbade them from shipping fuel to Africa and Asia, Russia is creating shorter routes for tankers traveling to those regions. Russia was compelled to search for new customers for their diesel, naphtha, and other fuels after the EU ban went into effect on February 5. Moscow needed to find a new location to market these goods if it was going to make money off of them. Like the cap on Russian oil, price caps also control the flow of Russian fuels to other nations. Lower-cost petroleum products have a $45 barrel cap, whereas Russian diesel has a $100 barrel cap. According to Serena Huang, head of APAC analysis at Vortexa, certain trade patterns are solidifying as Russia restructures its oil sector. With 1/3 of all Russian oil imports in February coming from China and India, these two nations rank as Russia's top strategic economic partners. Huang observes that a small number of nations in Asia and the Middle East are the primary recipients of Russian exports of fuel oil, naphtha, and crude after the EU prohibition. Nonetheless, quantities of diesel are being shipped to a number of nations, such as Saudi Arabia, Turkey, and Brazil. Russian diesel exports saw a significant 33% spike in March. They shipped the diesel from their ports on the Black Sea to countries in the East and West Mediterranean, including Tunisia, Egypt, and Libya. Additionally, the ports around the Baltic Sea no longer export diesel. They have fairly evenly dispersed among nations such as Saudi Arabia, Egypt, Morocco, Brazil, and Egypt. Moreover, the US has failed to persuade Saudi Arabia and the United Arab Emirates to stop purchasing fuel from Russia. Now, Russian oil exports to the Middle East are rising despite US efforts to dissuade Russia's OPEC Plus allies from buying Putin's oil. The Undersecretary of the Treasury for Terrorism and Financial Intelligence, Brian Nelson, traveled to Turkey, Abu Dhabi, Dubai, and Oman earlier this year. He continued by talking about the Treasury's initiatives to stop Russian attempts to circumvent international sanctions. Additionally, he discussed export limits as a result of its war against Ukraine, Iran's destabilizing actions, and illicit financing, which jeopardizes international investment and economic progress. However, the growing gasoline imports from Russia by the UAE and Saudi Arabia suggest that the US is losing ground to its main Middle Eastern allies. Furthermore, Gazprom has stated that Europe would find it extremely difficult to stockpile enough gas for the upcoming winter. Gazprom stated that restocking Europe's natural gas supplies for the upcoming winter would be difficult. This winter, European industries may find it difficult to restore gas supplies to pre-pandemic levels. Gazprom mentioned that this might be difficult on its Telegram social media page. The business also stated that political moves against buying Russian pipeline gas may pose a challenge for European companies. The amount of gas available on the European market will also be impacted by the competition for liquefied natural gas. Gazprom cut or halted gas supplies to numerous EU nations following Russia's incursion into Ukraine. The EU states refused to pay them in rubles, even though that was what they requested. Additionally, Gazprom occasionally stopped supplying Germany with gas via the Nord Stream pipeline. They said that due to Western sanctions, they were unable to repair the turbines. Gazprom cut off the gas supply once more right before explosions occurred on the Nord Stream pipelines in the Baltic Sea at the end of September. As of February 16, storage spaces around the European Union were over 50% full. Additionally, there is more gas in storage now than it was during the previous 2 winters combined with the average of the last 5 years. It was somewhat of a surprise that both this year and previous year's winter was so good. But that does not mean that Europe is out of the energy problem. There is still work to be done. Short-term natural gas prices may be low, but in recent weeks, the futures prices for Europe's benchmark prices have risen. This indicates that concerns are raised about whether Europe will have adequate gas for the upcoming winter. The December futures price has increased despite recent warmer weather and the greatest level of gas inventories in 10 years. This implies that people are still worried about stockpiling Europe's gas reserves for the upcoming winter and are unsure about the availability of France's nuclear fleet. According to unnamed sources with access to confidential Russian Energy Ministry statistics, Russia seems to have adhered to its January commitment to cut back on crude oil exports by 300,000 barrels per day, BPD, this quarter. Russia announced that it would expand the export cut to 500,000 BPD in the first quarter of 2024 during the most recent OPEC Plus meeting, which took place at the end of November. The reference export levels for the decrease would be May and June 2023. This quarter's drop will be made up of 200,000 BPD of refined products and 300,000 BPD of crude exports. Russia is thought to have exported 4.59 million barrels of crude oil per day last month via pipelines and tankers. Based on a translation of tons into barrels by Bloomberg, the drop from the May to June average, which served as the benchmark for the export cut, equals to 307,000 BPD. According to tanker tracking data tracked by Bloomberg, the 4-week average of Russian exports in seaborne oil shipments alone was slightly over 3 million BPD in the 4 weeks leading up to February 18, exactly in line with the Russian commitment to cut exports by 300,000 BPD. But problems with sales to India at a time when the West is enforcing sanctions more strictly might have damaged Russian crude oil shipments more than Moscow had planned. According to ship tracking data collated by Bloomberg analysts, up to 15 million barrels of Russia's Sokol grade, originally intended for delivery to India, lie idle on tankers near the coasts of South Korea and Malaysia. According to Indian officials who spoke with Bloomberg, some of the tanker owners were sanctioned by the US after loading crude for India, while other cargoes are being held up by banks refusing payments because of the oil price exceeding the G7 price cap or because it's unclear who the ultimate owner is. What are your thoughts on Saudi Arabia and OPEC Plus new oil strategy? Let me know down below. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching and I'll see you in the next one.